Hey, Dan here, and I am here with Eric Ravenscroft. Eric is a real estate professional with a very interesting financial background. I'll let him share that with you. But we have been collaborating on this California to Arizona real estate move. I guess pun intended on the move part. But we're going to talk about changing your rental property portfolio out of California into Arizona. And you can see from the slide here, more money. There's a massive opportunity to increase your revenue in Arizona and less headache. And we're going to get into the multitude of ways that you're going to experience less headaches. So, Eric, thanks for joining us. I appreciate that.
Yeah, thanks for having me. I'll kind of dive into a little bit just to give everyone a brief overview of my background because, like you said, it is unique. If you don't mind.
No, that's great. And people know me, and just in
Yeah,
case, real quick, that I'm a founding faculty member from the National Institute of Financial Education. NIOFE.org is the website. Been helping people for a couple decades now, and this topic of real estate investing has really moved to the forefront in my business and with my referral partners. So that's why I invited Eric on here. All right, Eric, go right ahead.
there we go. Segues perfectly. My name is Eric Ravenscroft. I am here based out of the Greater Phoenix Metro in Arizona. I'm actually from Southern California in Ventura County, so familiar with the California market and really the movement from California to a market like Arizona. My background is a little unique, like Dan explained. I started in the financial planning, tax planning, and wealth management world. Was in that space for about 13 years, and then realized that there was an opportunity that the two industries of financial planning and real estate often are disconnected. They don't talk to each other, and both really fit into your overall financial picture. So I decided, about 8 years, 9 years ago, to merge the two into one offering real estate services, but also offering financial planning concepts, insights, and strategies to, again, bridge the two industries into one.
Yep, and that's the reason Eric and I first connected because I work with a lot of wealth advisors. Have one in the family, have two in the family, excuse me. I forget my nephew. Have two in the family and work with dozens and dozens around the country. And Eric hit on it beautifully. There is a massive disconnect with wealth advising and rental real estate. That's for another webinar, and trust me, it's coming
Yeah.
because I'm having this discussion daily. But Eric brings a very unique aspect to it that really has blown me away. So I'm happy that he's joining us today. So, what is driving investors out of California and why now? And man, there's a long list. We're going to get into many of those things, but to preview them, we have insurance. We have regulatory risk, which means landlord unfriendly laws here in California. We've got tax considerations. Um, the insurance tsunami is definitely coming. It's already kind of here, but we're at the beginning, not at the end. And then lastly, and we're going to dive into this, the rent to price ratio, which is a big topic of mine and really drives my investing in real estate and my clients' investing. So there are so many reasons, but Eric, I don't know if you want to jump in and add anything to that.
Yeah, I mean, I was one of them living in California. One of the reasons for me was just inflated cost. The other was, being, again, if I look at the financial planning and real estate world, I'm always assessing risk. And like you had mentioned, that was one big thing is California being very, very tenant friendly versus homeowner friendly, which, Arizona is very, I would argue, one of the most homeowner friendly, landlord friendly states in the entire country. But those two big things were kind of the motivator for me.
Perfect. Yep, it definitely. So I want to focus, and a lot of my discussion focuses on what I call the typical one home investor. And it can be two homes, it can be three homes, it can be four homes in your investment portfolio. But by and large, the overwhelming number of people I deal with is someone who bought a first home, outgrew it, decided to keep it. I'm going to rent this home out, and then moved to a larger home. Maybe they moved out of state. Maybe they moved to a smaller home closer to the beach here in California. But the typical one home investor, and that investor shares some key characteristics that I'm not kidding you. 99% of my one home investors share these characteristics, and we'll get into that here in a second. Okay, so really quick, the beginning of this story was a $1.4 million home in the Bonita area that the client was interested in improving. They had deferred maintenance on it. The tenant had moved out, and they came to my business partner and me for $75,000 they wanted to access. They had a ton of equity, but they wanted to access 75K for home improvements, deferred maintenance. And we got into a lengthy discussion. Bottom line is they ended up selling and moving their investment out of California. So we'll get into that. But I just wanted to share, this was really the genesis of our story. So, like the client I just pointed out, the typical one home investor doesn't increase rents. They don't approach it like a business. The typical one home investor, I hear this, like I said, 99 times out of 100. They're a great tenant. I don't want to lose them. So I don't want to raise the rent $100. I don't want to raise the rent $75 because I don't want to lose them. Well, over time, it's easy for the one home amateur investor to say, I'm not going to raise rents, and they never do. And they fall further and further and further behind the market. And to go back to what Eric was talking about, the regulatory and risk, now we have rent control issues we have to deal with in California, and they can't catch up until the tenant moves out. So I don't know, anything you want to add there, Eric? Have you experienced the same?
Yeah, I mean, you get stuck, right? If you're charging, I've seen some just from my own portfolio when I was there of what I could have rented it out to clients that have moved, investors, you're kind of in a pickle, right? It's, oh, I'm charging 3,000. I should be charging 4. Well, you can't just wake up one day and say, oh, I talked to Eric and Dan, I'm going to charge 4 now because of the rules in place. So I've seen it a lot. Like you said, you need to treat it as a business. And even if you increase the market or the rent to the market value and you lose that renter, that tenant, there's thousands and thousands of individuals that are looking daily for rentals, especially in, I'd say everywhere in the West Coast where there's a ton of movement, a ton of growth and development. But yeah, to your point, treating it like a business, but you also can get stuck if you do kind of play that card of just allowing people to continue paying the same rate. Your rent needs to adjust with the market every single year, and that's what I do with all my portfolio, everything in my portfolio. Luckily here, we don't have rent caps, rent control. Actually, it was in 2021 because of some of the locations of my rentals. They increased 30% in a year because that's what the market was demanding.
Yep, exactly. Deferred maintenance, as I mentioned with that's the case that we started with. I have a great client. They're taking care of the home. That's the other one I hear constantly, constantly. They're
It's
taking
more like
great
they're
care of the
not
home.
damaging the home, right? It's
Right. Well, I always ask, so when was the last time you walked through it? Oh gosh, it's been 2.5, 3 years.
yep.
Well, even the best tenants have things that they wear out, that they break, that they don't take care of perfectly. So this is one of the other key areas that the one home investor ignores. And there's no other word I would use. They ignore the deferred maintenance, and they think they're making all this money, but they haven't put anything aside for items that may come up. And once again, this is treating it more like a business. And interestingly enough, and this kind of hit me when talking with Eric a few weeks ago, going to short term, we'll get into short term rentals in a little bit. You have to pay attention to this stuff. It's an interesting dynamic of the short term rental, right?
Yep. Yep, exactly. And the other thing too is when you look at different markets, when homes were built. right? California, you're going to have older homes. There's going to be larger, big ticket items for a market. And I'm just going to mention the Phoenix Metro. Obviously, that's where I'm at. We're comprised of a lot of newer homes. And a lot of those newer homes, you don't really have much maintenance. Your roof is going to last 25, 30 years. HVAC with proper maintenance and not deferring it, you can see HVACs lasting 25 plus years. You don't really have plumbing issues because we're not dealing a lot with, poly plumbing or copper lines. Um, Foundation is post tension, so you don't really see any issues with that. So that's kind of the other benefit. I was actually just working with this on a client last week. We were talking about that, the differences of just maintenance in general, maintenance items that would come up, given that we have a lot more new construction and newer homes. It's pretty minimal compared to other markets.
Yep. It's a key item. And it's, once again, it's so typical that this gets ignored. Regulatory headaches. Man, we've got a list. We previewed that. The rent caps, the eviction, squatter issues we're dealing with here. And I personally believe we're not at the end. It's that pendulum is swinging and it hasn't stopped. And things will get worse. In addition to at the state level, like Eric talked about the rent caps, you've got local municipalities that will add on and make it worse and worse and worse. There's rules in Chula Vista where my house is. It's just amazing what different communities are doing, and there's a cost to it. And I like to describe it, there's a profit sucking aspect to all of these regulatory problems. And this one, some of us has felt it a little bit today, depending on where you live. Once again, I believe it is going to get worse and worse and worse. And the insurance companies are handcuffed by the state. The state says it's the insurance company's problems. Well, the bottom line is the homeowner is going to be affected negatively. And Eric, I know this issue is not going on over there.
Yeah, not to that extent. I mean, I just did a little bit of a cost comparison analysis on Monday for a client there specifically as well in California in Ventura County, and we just compared because our homes are similar size, right? My home being 2,400 square feet, theirs being 2,400 square feet. My insurance annually is $680.
Ah.
They didn't tell me what theirs was. Maybe they didn't want to share, but they said I can guarantee you it's 4 times that amount easily, and it's going to be a lot higher soon. So, yeah, we don't
Yep.
see that anywhere close to what you're seeing in California.
And so from an investor standpoint, we have our profit and loss statement, and we've got a line item that we have no control over that gets worse and worse. It's taking more and more of the profit. And that line item is not going to improve. It's just
Yeah,
not. And I think it's
yeah,
going to get worse a lot quicker.
yeah,
So
absolutely.
what choices do I really have? I own a property in California. To me, you have three choices. You sell the property, you pay capital gains tax if you want, and you invest the money. That's option one. Option two is you move your real estate investment to a different market, to a different state. There's many ways to go about that. We'll talk about the 1031 exchange here in a minute. And the third is, and I have a few clients like this was great grandma's house. They're never selling it. Okay. So what can we do to improve the profitability of it? How can we help educate them about the laws, making sure they're treating it as a business? Oftentimes I'll recommend get out of managing it, hire a professional to manage it. So those are the choices that I see. Anything that you would add there?
Nope, you hit it all.
Okay. So there's the short and long-term option, and then there's a third option that maybe is both. And Eric, I'll let you talk about these.
Yeah. So I'll hit the two that are more common, right? Long term, short term. Long term is going to be you're going to have a tenant in the home for usually a year, right? 12-month minimum. A lot of times they're going to have utilities in their name, so that's their responsibility. They'll bring their furniture. And depends on your market, different rules. For example, here in Arizona, you could pin pest control, you can have them pay for that, you can have them pay for landscaping, the pool, all that kind of stuff. But that's going to be long term. You're not going to be able to charge as much but your risk is also lower. Then you have short term. Short term is the other word for vacation rental, also Airbnb, Verbo. That is the short term side. I like to call it the revolving door, where you have people in and out on a weekly basis, sometimes every other day. So that is more the short term. You're going to have much higher risk because you have more people stepping in to that home. You also are responsible for furnishing the home. And now furnishing goes much beyond just having furniture. You're talking linens, you're talking silverware, plates, activities. There's a lot that can go into that. But of course, the revenue is much higher on that end. And in markets, California can do well, but in markets in Arizona, specifically the Phoenix metro, short-term rentals, vacation rentals perform very well. And then you have the strategy smack dab in the middle, which is becoming one of the more popular strategies, which is midterm. So you don't have a long-term tenant in there, but it's also not a revolving door short-term situation. It's exactly what it equates to, is it's a midterm rental. It could be a month long, could be 2 months, 3 months, 4 months long. It's still furnished, but because it provides flexibility, because it provides, a very low maintenance furnished option for tenants and renters, you can charge not as much as a short-term rental, but pretty dang close to that. So here, popular options for midterm are pretty much all across the Phoenix metro.
And Eric, so give a little insight to the folks watching that you're on the west side of Phoenix,
Mhm.
relatively close. A lot of your activity is relatively close to the spring training facilities for a lot of teams, as well as I believe the chip manufacturers are
Yeah, so
relatively
you
close
have
as well.
Yeah, you have chip manufacturers. You have a Boeing facility. Looking at it, I'm a huge sports fan. Obviously, we share that in common. But I look at spring training when that's here from February, March, and bleeds into April some years. But then you also have State Farm Stadium, which is home of the Cardinals. You have concerts. You have big shows there. You also have the Super Bowl. You have the Final Four. The years when the Final Four and Super Bowl are here, some owners, they pretty much make their year just in those 2 weeks alone. Um,
Wow.
so that's a lot of the opportunity. But then you have things such as traveling nurses. Oh, traveling nurses don't want a long-term rental because they're not here for 12 months. They also don't want a short-term rental because, well, they need something a little bit longer term. So that's where the midterm strategy comes in, 3 to 4 months. I have several traveling nurse clients looking to buy soon, uh, but when they go to a new market, they literally have a backpack, their laptop, their phone, and a suitcase. So they don't need anything else. They don't want anything else. So that's where the midterm comes in really handy, is from a risk standpoint, those are the clients and tenants you want. Someone that's never going to be there, that's going to be working all the time, or it's a
Yep.
snowbird. Like obviously, Phoenix Metro, we're one of the most popular areas for snowbirds to come escape the colder weather in the fall, in the winter, and in parts of the spring. They're going to take care of that home better than you would, most likely. They're not throwing parties. You're not going to have the risk that you would from a short-term rental. And the revenue's pretty, like I said, pretty dang close. So a lot of opportunity. The other option with a midterm rental too is, say we have a lot of new construction. Someone's building a home here, but the home's not going to be ready until October. Well, they need to find housing by June because they have kids and they want their kids to go to that school. There comes the midterm rental strategy. That family can stay in that home, keep their stuff, say in California, in storage until their new home's ready, and the kids get to be in district and go to that school. So a lot of strategies and a lot of opportunities. I actually have a list, about 20 different strategies and focuses. Some clients pick and choose from those, but a lot of opportunity, obviously on midterm, short term, but especially with the midterm rental.
Yeah, the midterm one is fascinating to me.
Yeah,
And I can see how powerful it will be because obviously you can pick and choose when you're going to do the midterm, but cash in and high season on the short term.
exactly.
Very cool. So real quick, I want to talk about one of the things that gets on a lot of people's radar is a tax problem by selling a rental property and buying another one. and they're concerned about capital gains taxes, as they should be. So you'll hear the term 1031, and a 1031 is really a tax deferred strategy that enables you to buy a like-kinded real estate asset. So, or assets. Real quick, if someone's selling $1 million home here in San Diego, they could buy two $500,000 homes in a different market, and that will help, that will meet the 1031 rule. They do have to bring the amount of indebtedness. So if they have mortgages on one or this one property, they have to bring that mortgage to the next property or properties. But it's really, it sounds like it's a very complex concept. I can say from a lending perspective, it's almost a non-issue. It's almost not even on our radar. It's such a small deal. And we work with 1031 intermediaries, they're called, they're experts. San Diego, I work with a guy here locally who's one of the experts in the industry, one of the top people. So we've done multiple transactions recently and they've gone great. But it's really 1031 is the tax law that describes this process. Okay. I want to talk about one key item here that's a big deal to me. And this is I use a filter, which is the rent to price ratio. It's almost like my first filter when we help clients or work on our transactions, our investment syndicate. We want to know what the percentage is of monthly rent to the price of or value of the home. So in San Diego, you're going to get $4,500 for $1 million home. So it's 0.45. It's less than half of 1%. In different markets, in Detroit, we're getting, with our syndicate there, we're getting well over 1%. It's amazing. But they're older homes, a lot of maintenance. There's a market in Memphis we're looking at that's well above San Diego. We have a lot of people going from San Diego and increasing their rental revenue 50% overnight. So that's the big filter or the first filter I use when I'm looking at that. And you may hear me refer to that, whether it's in a one-on-one conversation or things I'm teaching, but I just want to put that on everyone's radar. Eric, anything you want to add?
No, I mean, it is very market specific, right? Like, I mean, even city specific, like looking at
Yes.
parts of California, parts of, Phoenix, especially. I'll talk about Phoenix. It's like, that could be 20 minutes, 15, 20 minutes. And you're seeing that shift from a 0.5% to 1%. So it is very, very, not only general market specific, but very, city and sometimes neighborhood specific.
So speaking of that, Eric and I were talking and we were talking about a strategy, a niche, and Eric, I'll let you take it from here, but this was fascinating to me. Let me put it that way.
Yeah. So I'll mention this is actually an example of a client that is actually in San Diego and had purchased this property. So this, you can see the four pictures there. Those kind of just key photos of the home. But this is a little bit of a unique property. 4,000 square feet, so large size home, 5 bedrooms. It has also a separate guest house that could be rented out separately. Again, traveling nurse, perfect strategy for this type of setup. It also has something that is, when I say rare, I'm talking very, very rare in Arizona, a finished basement. We don't see many of them, mostly because the ground is so hard. It's very expensive to do basements here. And then something that's almost required and needed for a midterm or short-term strategy would be a heated pool and spa. Contrary to popular belief, you cannot use the pool year round here. It does get cold really from October into November and then all the way really to about now. I mean, we just hit 80 degrees today. It was cold and rainy before, so that pool cannot be used. So having it heated gives you year-round access. So for these clients, as you can see in the profile, they're high earners, a nurse and a CEO in their early 40s. Their revenue on utilizing the various strategies that we talked about, short-term, midterm, 120 to 140,000 a year. Now on an $800,000 house. Now, Dan, I could probably go out on a limb and say you've not seen those numbers. 800,000 for that size of home, but that revenue as well out there.
No, and I'll jump in here real quick. An $800,000 property in San Diego County is going to get $40,000 a year in income. That's it.
And size of the home, well, we're talking what,
Yeah.
1,600 square
So,
feet?
oh, you're talking a condo, a
I mean, that's
smaller
what that
home
would,
that's,
yeah,
yeah, you're talking, I don't know, 1,600 square feet.
yeah,
And, going off the math I was using earlier, an $800,000 home, guarantee you're renting it for 32 to 3,500 a month.
sure.
So this is just to me a no-brainer for someone who's in California that has that property to, okay, I'm going to go triple, quadruple the income potential by doing something like this. So anyways, I'll let you keep going. I'm sorry,
Yeah,
Eric.
no, no, you're good. Uh, the thing to know too is we look at the location. So this is happening all over. These opportunities are all across the Phoenix Metro. Specifically, why I'm looking at Goodyear, and this was something that had a long analysis process and discovery phase with the client was where are we going to get great value? Where are we going to get that size of a home? But where do we have the flexibility to cash flow on a long-term basis, as well as have the need for the midterm and short term? So all the strategies that Dan and I had talked about, or I mentioned previously, snowbirds. Goodyear's a big market for snowbirds. Spring training. There's a spring training stadium in Goodyear. There's one, two, three others within 10 to 15 minutes. This specific property is 15 minutes away from State Farm Stadium, fully booked throughout the spring, up until summer. But then also it's in an area where there's a lot of new construction. So again, if someone wants to be here by June, they want to be settled, they want their kids to be going to a specific school, these are all strategies that these specific clients implement and follow to ensure that it's fully booked all throughout the year.
Yeah. It's just astounding how different the financials are from San Diego to this property. It's mind blowing. It really, really is.
And you look
Cool.
at
All
the
right.
one thing too is like the size, right? If you were to find a 4,000 square foot home with a guest house and a basement, heated pool in your market, I mean, would you have any idea on how much something like that would cost?
2.5 million.
Yeah. Yep. So
Yeah.
now you're talking about all the property tax on that, the insurance on that, all the different costs that come, the maintenance on that.
Yeah.
So this is just one of the many examples here, where, like Dan was talking about, being able to do a 1031 or just exploring the opportunities here with various strategies to really kind of change your overall financial picture.
So Eric, let me ask you a question on the projected revenue. And I know that's probably a midterm or of a bundle of different short term,
Yep.
midterm. If you just went out and said, I'm renting this long term, I'm going to have someone sign a 24-month lease. What are you getting a month for this?
45 to 5 or so.
Okay.
Yeah.
Yeah.
So
So,
definitely, oh, go ahead.
once again, 60% higher than here. I
Yeah.
mean, overnight.
Yep.
Six,
Yep.
it's crazy.
And this is the example where those clients specifically had a little bit more risk tolerance. They wanted the tax break. That's a topic for a whole other, webinar that we'll get into. But it is kind of what I say to everyone is you have the option to pivot. Where other markets, it's too expensive. I have to do a short-term rental or a midterm rental to even make it. If I go long-term, I'm losing. So there's a lot of these opportunities all across the Phoenix Metro where it's, hey, step one, let's make sure it cash flows. But hey, here's the potential for just doing a little bit of work. And again, like you said, treating it like a business, versus a hobby or doing a favor for someone.
Yep.
That is the key.
Yep. Exactly. Exactly. Perfect. So This is, I want to share three questions that I ask investors or or current investors or people that come to me looking for advice. The first question I ask is, how is the financial performance of of my current property? I want the client to ask that to themselves. And oftentimes I'll get good or bad or indifferent. It's a very, generic type question, but there's a purpose to that because I'll move to my second question was, what metric are you using to support that answer? So someone will say it's performing well. And I said, okay, what metric are you using to support that answer? Oftentimes I get, well, so and so is paying my mortgage, or they're paying my PITI. And that's good. There's nothing wrong with that, but that's not a financial metric or an investment metric, right? The last question is, what's more important, cash flow or appreciation? Oftentimes people here in San Diego will say, oh gosh, appreciation's great here. Well, there's only one way to, or two ways to take advantage of that appreciation. You sell it or you refi and take cash out of it. Otherwise, your third option is you pass away and give it to someone else. So once again, there's nothing wrong with appreciation. Arizona, Eric's marketplace continues to have strong appreciation, but you can do a lot of good things by doubling your income.
And I always mention this to everyone, clients, other advisors too, when they have this conversation is, when you look at a rental, when you look at your primary and you're just banking on appreciation, it's kind of using the visual of you just have dollar bills instead of, stucco or framing. Your dollar bills are what is around the home. It's not doing anything for you. It's kind of there. Can you take it away from it? No, because if you took it away or sold it, like you said, you're going to realize either a capital gain or there's ways to do it. But if you're living in it, if you're investing it, you're renting it out to someone, and oh, they're a good tenant. I don't want them to upset them or lose them. Again, it's just kind of that visual of money's actually not working for you. It is, but it could be working much better and much more efficiently for you.
Yeah, it really is. It's working for you, but it's kind of like a lazy employee in a way.
It's just,
It's
yeah,
just hanging
yep,
around there. Perfect. So obviously, one of the things you probably hear me posting about is our latest book. My business partner Todd and I have this book out, and it's our story on this epiphany. This has been a big change in my mind the last couple of years, how I've approached this, and so that's out there. But bringing it all together, this is the key point, and we're doing this. Eric and I are starting to collaborate on this. If you have a property here in California, I would encourage you, it could be the best property, you think it's doing great. I would encourage you still to say, let's compare what's possible somewhere else, just for your knowledge. So I always believe the best thing to do is have all of the knowledge or as much as you can get and make a decision from there. But if you're investing to make money, the brainstorm I have had that San Diego is not the place to do it for a lot of reasons we just outlined. And then Eric can share with you kind of what he does as well when we look at these properties and this change.
yep, yeah. Really looking at all elements, all cost. Again, it's a business at the end of the day. If you're looking at it to generate income, to grow your wealth, it's a true, as I call it, a cost comparison, analyzing every single element of that property as well as the other opportunities that are out there.
Yeah, Eric's cost comparison analysis, that's the right term, right, Eric?
Yep, yep,
He'll look at things like insurance on the home, what the difference is going to be from market to market. We can model out the mortgage, what it would look like going from California with your 3% mortgage to a 6 or 7% mortgage. And we'll look at the financials and see the impact that that has. But I am seeing so many opportunities for people to really change their lives in a much better way by reallocating their investment elsewhere. And we're here to help you do that. So, Eric, thanks for joining me. We'll make sure
yeah.
this
Thanks
is
for having me.
available. Anything else you want to close with?
No, I would just say like this is going to be a more uh, recurring series. We have a lot of ideas for wealth building concepts, various strategies that could really help people, and it's something that and Dan and I talking about these often. They're topics that most people aren't aware of. Some of the concepts that we talked about, you hear about, you read about, but putting it into action is a completely different story. And that's really what we want to gain as our goal to educate with all these strategies. So looking forward to more of these talks and more of these concepts to ensure we get as much information and education out there.
Yeah, and our next one, which hopefully we'll be doing next month, we're going to dig into the financial details of what one of these looks like, a case study to say, hey, you're going to sell your $800,000 condo here. What does the financials, all the way from the top to the bottom line, the tax impact or no tax impact? And we're going to walk you through the numbers so you get a real good handle. But today was really about just creating awareness around all this stuff. So thanks, Eric, for joining me. I really appreciate it. And I'm excited for what's going to happen.
Yeah, me too.